This is part two of the lecture on the allocation of deductions related to business income. Now let's discuss the allocation of interest on qualified non-recourse loans. Interest expense on qualified non-recourse debt is allocated to the income from the property financed by that debt. This rule is applied when the following conditions are met. The debt is incurred to acquire the property in question. The property is depreciable or amortizable with a life of more than 1 year. The debt proceeds were used to acquire the property. The debt is non-recourse, meaning that the creditor can look only to the property to guarantee repayment of the debt. Cash flow from the property is expected to be sufficient to service the debt, and loan covenants are consistent with the above requirements. For purposes of the three-step method of allocating interest discussed above, any debt that is allocated under this rule is netted against the related asset, and then the debt is ignored. Here's an example of the allocation of interest on non-recourse debt. Foreign Corp., a Country X corporation, borrows $100,000 in order to purchase an apartment building, which it then purchases. The loan is secured only by the building. Annual debt service on the loan is $12,000. Annual gross rents from the building are expected to be $20,000. Other expenses of the building total $4,000. The net cash flow before debt service of $16,000 is expected to remain steady or increase in subsequent years and is sufficient to service the debt. This example is continued on the next slide. The loan covenants are consistent with the requirement that the lender can look only to the building and rents for debt service. Under this example, interest on the debt would be allocated to gross rental income. If the price of the building in this example is $120,000, then $20,000, the building's cost less non-recourse debt, is used in the three-step process for allocating interest, and the $100,000 of non-recourse debt is ignored in that calculation. Another type of direct interest allocation involves integrated transactions. If a foreign corporation borrows to fund an investment, the entity must allocate the interest expense to the income from the investment if the other requirements set out in the regulations are met. Here's an example of an integrated transaction. Foreign Corp. Is a Country X corporation that borrows from an unrelated lender and uses the proceeds to purchase credit card receivables. If all of the requirements of the regulations are met, this can qualify as an integrated transaction. If it does qualify, the interest expense is allocated to the income from the receivables. For purposes of the three-step calculation, only the net receivables are recognized and the debt is ignored. Let us turn briefly to the allocation of interest to non-resident aliens and foreign trusts and estates. Trade or business interest expense is generally allocated and apportioned. All allocations and apportionment of interest expense are made on the basis of assets rather than gross income. The regulations provide that a non-resident alien, foreign trust, or foreign estate that incurs business interest must apportion such interest using an asset method by reference to the individual's or trust or estate's business assets. The asset method is discussed in the next slide. Note that the three-step approach discussed in the earlier slides applies only to foreign corporations, not individuals, estates, or trusts. Interest of a non-resident alien or foreign trust or estate is deductible only if it is effectively connected. Under the regulations, the interest is effectively connected if the interest relates to liabilities entered in the books and records of the U.S. business, or the interest relates to liabilities secured by assets that generate effectively connected income. Interest that is secured by assets other than those used in a U.S. trade or business is not effectively connected. In addition, interest expense is not effectively connected to the extent that it is incurred with respect to liabilities that exceed 80% of the gross assets employed in the U.S. business. Following is a discussion of the asset method for allocating interest expense. This is a default approach for allocating and apportioning interest. The three-step approach discussed earlier applies only for foreign corporations. Under the asset approach, interest expense is apportioned based on the average total value of assets producing income within statutory and residual groupings. There are two methods of apportionment based on assets: tax book value and fair market value. The annual average of asset values within each statutory grouping and the residual grouping is computed for the year on the basis of total value of assets in such categories at the beginning and end of the year. Assets generally are characterized according to the source and type of income that they generate, have generated, or may be reasonably expected to generate. Here's an example of the application of the asset method. Domestic Co. is a U.S. corporation that has deductible interest in 2010 of $150,000. It apportions interest expense using the tax book value method. The adjusted basis of its assets is $3,600,000, $3 million of which generates domestic source income and $600,000 of which generates foreign source income. None of the interest is directly allocable to an identified property. Domestico apportions its interest expense as follows: $150,000 times $600,000, or $3.6 million, gives you $25,000 apportioned to foreign source income, and $150,000 times $3 million divided by $3.6 million gives you $125,000 apportioned to U.S. source income. The regulations provide extensive rules for allocation and apportionment of research and experimentation costs. A complete discussion of these rules is beyond the scope of this course. Following is an overview of these rules. Where research and experimentation is undertaken solely to meet the legal requirements imposed by a political entity, and the results cannot reasonably be expected to generate more than de minimis amounts of gross income outside of a single geographic source, the research and experimentation is allocated to the jurisdiction imposing the requirements. An example is testing to meet the requirements imposed by the U.S. Food and Drug Administration, where the test results cannot reasonably be expected to generate more than de minimis amounts of gross income outside of the United States. In this case, the cost of testing is allocated solely to U.S. source income. Other research and experimentation costs are allocated under either the sales method or the gross income method. Under the sales method, 50% of research and experimentation costs are allocated to the country where the majority of research takes place. And then 50% is allocated between U.S. and foreign sources in proportion to statutory and residual groupings based on proportions of sales from the product categories.
Under the gross income method, 25% of the research and experimentation costs are allocated to the country where the majority of research takes place, and 75% is allocated between U.S. and foreign sources in proportion to statutory and residual groupings of gross income without dividing amounts into product.
Here's an example of allocation of research and experimentation costs. Domestic Co. is a U.S. corporation that manufactures and distributes lawnmower engines. Foreign Corp. is its wholly owned Country X subsidiary and also manufactures and sells these engines abroad. In 1996, Domestic Co. incurred research and experimentation costs of $60,000, which it deducts currently. The costs are research and experimentation expenses to develop a new engine. All of the research and experimentation was performed in the United States. In 1996, the domestic sales of Domestic Co. of the new engine totaled $500,000, and foreign sales by Foreign Corp. Totaled $300,000. Domestic Co. provides technology for the manufacture of engines to Foreign Corp. Under a license. This example is continued on the next slide. Under the sales method, the first 50% of research and experimentation costs, or $30,000, is allocated to the United States, where the research took place. Of the remaining $30,000, $11,250 is apportioned to foreign sales. This amount equals the $300,000 of foreign sales by Foreign Corp. Divided by combined sales of $800,000 times $30,000. Let me conclude this lecture with a discussion of the losses on personal property other than inventory. Loss recognized with respect to personal property other than inventory is allocated to the class of gross income to which the gain from a sale of such property is assigned or would be assigned if there was a gain. As noted in the lecture on the sourcing of income, gain from the sale of personal property other than inventory is generally sourced to the taxpayer's residence except for depreciable and amortizable property, which can also be sourced, at least in part, to countries of use or sale. Consistent with these rules, in the case of depreciable personal property, the gain referred to above is gain that would be sourced under these rules if it occurred. Here's an example of the allocation of loss on depreciable personal property. Domestic Co. is a U.S. corporation that in 2000 purchases for $1,000 a machine that produces widgets which Domestic Co. sells in the United States and throughout the world. Throughout Domestic Co.'s holding period, the machine is located and used in Country X. During its holding period, Domestic Co. incurs depreciation deductions of $400 with respect to the machine. Under Regulation 1.861-8, the company allocates and apportions depreciation deductions of $250 against foreign source income and $150 against U.S. source income. This example is continued on the next slide. In 2002, it sells the machine for $100 and recognizes a loss of $500. Because the machine was used predominantly outside the United States, the disposition of the machine at a gain would be foreign source income to the extent of the depreciation adjustments. Therefore, the entire $500 loss is allocated against foreign source income.